Welcome to This Explainer. Today, we're putting on our sell-side equity analyst hats to conduct a rigorous, fundamental deep dive into Zeta Global. They trade under the ticker Zeta on the New York Stock Exchange. Look, we're going to strip away all the market noise today and look strictly at the underlying business reality. We're talking products, competitive moat, operating metrics, and of course, cash flow generation. Our goal here is to build a metric-driven valuation framework based entirely on the company's recent filings and reported financials. No fluff, just the fundamentals.
Okay, let's dive into this, because right out of the gate, we are confronted with a massive market disconnect. If you pull up the trading data, you'll see Zeta Global's stock took a roughly 27% hit early in 2026. Now, if you're just watching the ticker tape, you'd probably assume this is a business in distress, right? Maybe they're bleeding market share, or their margins are getting totally squeezed. But as we're about to see, the fundamental reality of this business paints a completely different picture. We're looking at a glaring paradox right now between a plunging stock price and surging financial metrics. To really grasp the scale of this disconnect, just look at this number, 78%. While the stock price was sliding, Zeta's free cash flow actually grew by an astonishing 78% year over year. And we aren't talking about some heavily adjusted pie-in-the-sky non-GAAP metric here. We're talking about hard, unlevered free cash flow expanding rapidly. This right here establishes the central valuation paradox we're going to break down today. How on earth can a company with this level of accelerating cash generation be priced as if its growth is hitting a brick wall? Well, to answer that, we first need to understand exactly what they do. Section 1. Products and Moat. Exploring Zeta Global's Edge.
So Zeta Global operates an AI-powered marketing cloud that basically targets massive enterprise-level clients, and their whole business model rests on three core pillars. First up, you have the Zeta Marketing Platform, or ZMP. Think of this as the omni-channel orchestrator. It lets brands manage their campaigns across email, social, mobile, and connected TV, all from one single dashboard. Second is their secret weapon, the Zeta Data Cloud. We're talking about over 2.4 billion deterministic identities. That means real, actual individuals, not just anonymous tracking cookies. Finally, they monetize all this through a brilliant hybrid model. They get that stable, high-visibility SaaS subscription revenue, but they supplement it with usage-based revenue tied to media activation. Put it all together, and this ecosystem helps huge brands drastically improve their return on ad spend.
And this brilliantly illustrates their competitive moat against the legacy giants. Look, Zeta operates in a land of absolute giants, going toe-to-toe with names like Salesforce and Adobe. But the market often criticizes those legacy clouds as, well, Frankenstacks. Basically, they're collections of different acquired technologies bolted together that don't actually communicate seamlessly. Zeta, on the flip side, built a unified AI-first platform completely from the ground up. By offering a lower total cost of ownership and letting companies replace multiple disjointed vendors, Zeta is out there actively winning enterprise deals away from these massive legacy players.
Section 2. Operating Metrics and Financials. So, the big question is, does this product advantage actually show up on the balance sheet? The answer is a resounding yes. Zeta has now delivered 19 consecutive beat and raise quarters. Let that sink in for a second. For nearly 5 years as a public company, through all sorts of crazy macroeconomic environments, they have consistently beaten Wall Street's expectations and then raised their forward guidance. That is not a pandemic-era fluke. That is hard, empirical evidence of sustained, compounding enterprise demand for their platform.
But you know, acquiring customers is really only half the battle in enterprise software. Keeping them and growing their spend is the true test of a platform's stickiness. Well, Zeta recently reported a record 120% net revenue retention rate. This is absolutely crucial for any equity analyst looking at SaaS models. It literally means that even if Zeta fired its entire sales team and acquired 0 new customers this year, their existing client base is expanding their spending by 20%. In fact, clients who have been on the platform for 5 or more years now average $3.9 million in annual spend. That is a cohort expansion pace that completely dwarfs industry averages. Let's look at how this momentum builds into their most recent quarter. In Q1 2026, revenue hit $396 million. That is up an incredible 50% year over year. They are successfully executing what's called the Rule of 67. So in software, if your revenue growth percentage plus your adjusted EBITDA margin clears 40, you're elite. Zeta is hitting 67. And you can see the foundation of this growth right here in their super-scaled customer cohort. These are the heavy hitters spending over $1 million annually. That group grew 19% to 189 customers, and the average revenue per user in this elite cohort jumped 21% to $1.7 million. Now, the primary catalyst driving this accelerating growth into 2026 is a massive macro trend known as Agentic AI. This is a huge leap forward. It's not just basic generative AI writing a quirky marketing email for you. Agentic AI acts as a conversational command center. Think about it. A chief marketing officer can literally tell the system, hey, reallocate $50,000 from underperforming social ads to connected TV segments showing high intent. And the AI independently executes that complex real-time strategy shift across the entire platform. It's wild.
Now, what's really interesting about this slide is how rapidly the market is actually adopting Zeta's specific agentic AI, which they call Athena. According to CEO David Steinberg, in its very first week of general availability, Athena drove greater than 7 times more agent interactions and instantly accounted for over 60% of all AI platform usage. This aggressive scaling proves that Athena isn't just some shiny new feature they're trying to push. It's quickly becoming the core operating system for their enterprise clients, which directly drives higher usage-based revenue.
Section 3. Cash flow and valuation. Let's get into the financial modeling.
While we might lack the exact granular inputs in these specific filings to build a flawless, down-to-the-penny discounted cash flow model, the sheer cash flow momentum here gives us an incredibly robust valuation framework. Just walk through this operating leverage. Unlevered free cash flow has expanded from a modest $34.8 million in 2021 to nearly $200 million on a trailing 12-month basis. And check out the free cash flow margin. It's steadily marching upward, moving from about 7.5% up to roughly 14%. What this proves is that the business model scales beautifully. As revenue grows, a much higher percentage of every single dollar is falling straight to the bottom line.
Because of all this compounding growth and their successful integration of the recent Marigold Enterprise acquisition, management actually felt confident enough to raise their 2028 financial targets. They are now projecting at least $2.3 billion in revenue, $573 million in adjusted EBITDA, which represents a healthy 25% margin, and a massive $371 million in free cash flow. The underlying math of the business strongly supports these projections, assuming, of course, they can maintain that super-scaled customer retention we talked about earlier.
But when you map these rock-solid fundamentals against the current stock price, the analyst community is seeing a massive, massive gap. With the stock currently trading in the 14 to 17 range, Wall Street's consensus price target is sitting way up at $30.31, with a high target of $45. Based on the company's 35% forward revenue growth guide and those expanding margins, analysts are modeling an implied upside of roughly 100%. Basically, the market is currently pricing Zeta as if growth is totally stalling out, while the financial filings literally prove the growth is accelerating.
So the crucial point is addressing recent insider activity, because, let's be honest, that kind of thing can really spook retail investors. SEC Form 4 filings show CEO David Steinberg recently transferred 1.26 million Class A shares. But here's the catch. The filings explicitly code these as bona fide gifts for trust, estate, and tax planning purposes executed at a $0 price. This was absolutely not an open market bearish sale. Actually, scratch the panic, because Steinberg still retains massive economic exposure and voting power through millions of Class B convertible shares. The founder's financial interests remain deeply, deeply aligned with the company's long-term valuation.
Section 4. Risks and headwinds. Exploring market challenges.
Of course, no objective equity analysis is complete without a solid look at the bear case. Zeta does face some material risks. First, despite thoroughly refuting the claims, a late 2024 short seller report from Culpa Research created a lingering market stigma that management just has to continually battle through absolute transparency. Second, that 2025 Marigold acquisition brings real execution risk. Large-scale integrations frequently face cultural friction or client churn. And finally, you have regulatory headwinds in 2026, like the EU AI Act and the ongoing death of third-party cookies. However, we should note that Zeta's early strategic shift to a 100% opted-in deterministic data model serves as their primary operational hedge against these exact privacy hurdles.
Ultimately, Zeta Global presents just a fascinating study in market psychology versus fundamental reality. We're looking at a company delivering 50% revenue growth, a record 120% net revenue retention, and rapidly expanding free cash flow, yet it's trading at a steep discount to its peers. The key variable going forward is purely execution. So I'll leave you with this to chew on. Will the aggressive enterprise adoption of the Athena AI agent serve as the undeniable catalyst that finally forces the market to wake up and align Zeta's stock price with its underlying cash flows? I'd highly suggest keeping a very close eye on their next earnings report.